Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to another episode of the Wall Street Lab podcast. My guest today is Rich Nuzum. Rich is the president for wealth at Mercer, and with 304 billion delegated assets under management, over 1,300 staff members, and over 15 trillion assets under advisement, they are the number one investment consultancy globally by assets under advice. Rich has held many leadership roles within Mercer, from president and global business leader to chief investment officer for Mercer's investment management business. He has held roles across the world, from Tokyo to Singapore to New York. He holds an MBA with high honors in analytical finance and accounting from the University of Chicago, and a bachelor's degree with honors in mathematical science and mathematical economic analysis from Rice University in Houston. He did also some graduate work at the University of Tokyo and is a CFA charterholder. We talk about what does an investment consultant do. We talk about how Mercer finds innovative investment managers, get a competitive advantage as an asset owner. Then we talk about the work and use of investment consultants and outsourced CIOs, and how institutional objective setting and risk profiling is done at Mercer. And of course, with the president of a company with 15 trillion assets under advice, I ask for some career advice. I hope you enjoyed this episode as much as I did interviewing Rich. And if you like it, please give us a thumbs up, a 5-star review on Apple Podcasts or wherever you get your podcasts from. And now, without further ado, our interview with Rich Nuzum. Hi, Rich. It's a pleasure to have you on the show. How are you?
Hi, Andreas. I'm great. Thanks. Thanks for having me.
Can you tell us a bit more about yourself? Who are you and how did you get to where you are today?
Okay. I lead Mercer's investments and retirement business globally. So that includes our institutional investment consulting, our provision of manager research to asset owners in a digital way, and our outsourced chief investment officer business. It also includes our retirement actuarial services and our bundled defined benefit and defined contribution capabilities. And it spans clients in 85 countries around the world. I joined Mercer 29 years ago in Tokyo, Japan. I was studying in graduate school at University of Tokyo under a professor who at the time was the Paul Krugman of Japan, but he went on, Kazumasa Iwata, to be deputy governor of Bank of Japan and an advocate for creative monetary policy, and probably did a lot to help rescue the Japanese economy from the global financial crisis. But when I knew him, he was just an economics professor. So I came out of Todai and Tokyo Daigaku, Tokyo University, and joined Mercer in Tokyo, and then worked Chicago, Tokyo again, Singapore, and now New York. Lots of roles along the way, always doing institutional investment consulting for large pension funds and sovereign wealth funds, insurers, endowments, foundations, family offices, other institutional asset owners.
There's a lot of my favorite countries on that list that you've worked. How did you end up in Tokyo in the first place?
Well, I'm pretty old now. So when I came out of school in the late 1980s, came out of university, I was at Rice University down in Houston. There were lots of people in Texas who were bilingual Spanish, English. So I had some Spanish, but that didn't differentiate me as a student. Japan was on top globally. Japan as a nation had kind of taken semiconductor manufacturing away from the US, had looked like it was going to take auto manufacturing away from the US. And the Japanese stock market represented 46% or so of the world stock market. It was trading at a higher valuation than the US. The city of Tokyo, the value of Tokyo real estate for the city was larger than the value of real estate in the state of California. So Japan was on top. And I got off the plane, and there were books like The Japan That Can Say No and The Japanese Economic Miracle and so on and so forth. If I'd been smart with perfect foresight, I would have learned Mandarin instead of Japanese, and I would have got off the plane in Shanghai or Beijing. But I got off the plane in Tokyo and planned to start a career in international business, get fluent in Japanese, go from there. That actually worked out. But in the 29 years since then, 30 years now since then, Japan has continued to do well. It's still a wealthy economy. It's still a major economy. But China has come up and up and up and up. And China passed Japan for a number of headquarters in the Fortune 100 a couple of years ago. China has now passed the US for a number of corporate headquarters, I think, in the Fortune 100. And so if the world was bipolar back then, it's now multipolar, with China having risen and also the EU along the way.
Interesting. I think I want to get into the question about global trends a bit later, but for everybody that maybe has not heard of Mercer yet, can you quickly explain what your company is doing?
Okay. Mercer helps employers with the health, wealth, and career needs of their employees. So we have three main lines of business: health, wealth, and career. Under wealth, we have investments and retirement. And on the retirement side, we're trying to design long-term savings arrangements, whether that's a Social Security fund for a government or a corporate defined benefit plan or a corporate defined contribution plan, and then figure out what you need to contribute to that plan over time to provide for retirement security for individuals. It could be citizens of a nation state or a municipality, could be employees of a corporation or government. On the investment side, we're then trying to figure out what's the best way to invest assets. And a lot of those assets are for retirement plans. There's some synergy and interaction between our work on the design and funding and accounting side as retirement consultants and our work on the investment side as investment consultants. But there are lots of asset owners that are not retirement plans. So insurers, sovereign wealth funds, central banks, family offices, and then the whole retail sector. We don't typically work with retail investors directly, but we work with the banks and insurers and dot-coms and financial planning networks that serve individuals. So we work with financial intermediaries on a B2B2C basis, recognizing that their end customer is a retail customer. And we help organizations make investment decisions, but importantly, we then help them implement the investment decisions. And the game is about being early and being right to capture innovation. So on one side, we've got 7,000 plus investment managers that are waking up every day to new information in the markets and trying to figure out how can we invest client assets to outperform in this environment. And on the other side, we've got about 7,000 Mercer clients that have existing investment objectives and investment programs and needs. And we're trying to match up that innovation from the investment community with those needs on an ongoing basis to achieve good results for our clients. And the client that moves fastest gets the best return when there's a good new idea or innovation. So being early and being right drives out performance. That's really our mission day in and day out.
How do you recognize innovation in that space early? How do you try to accomplish that for your clients? And a follow-up question, how many of your clients, for example, pension plans, are really active in jumping onto innovation, right? I always thought they are more the very traditional investors, only investment managers that have like a 5-year track record, something like that.
Okay, great questions. I'm going to divide the answer into three. On innovation, we have two key competitive advantages. One is because we're representing $15 trillion with a T in client assets as a consultant, investment managers have a very strong incentive to bring their best ideas to us first. If they can impress us with an idea, we'll take it to a lot of clients. They'll get assets to manage against that idea. They'll be able to commercially exploit that idea before their competitors engage in parallel invention and move the market pricing to get rid of the value of the idea. One competitive advantage is we get to talk to all the smartest people in the industry around a particular innovation, and they don't share their secret sauce with each other, but they're sharing it with us. And so if I have 8 investment managers come to me with the same idea and they're all claiming it's innovative, I know, but they don't. They're all engaging in parallel invention, and none of them really have competitive edge. They're all onto the same thing, and market prices are going to adjust quickly, and the value of the idea is going to be eliminated very quickly by market efficiency. If I talk to those 8 and one of them clearly has seen around a corner and is onto something that the other 7, as smart and well-resourced as the other 7 are, they're not onto it yet, then I know that one has something innovative. And if we bring that to our clients have a chance to buy in early. And then when the rest of the market comes to understand what that first innovator already understands and buys in behind, our clients will get a gain. So our first competitive advantage is the number of smart people that come to talk to us, and they're not talking to each other and not talking to our competitors in the same way, because our competitors are smaller and not as well resourced to listen. The other big competitive advantage we have is because we have a model that delivers our research digitally to the in-house staff of the largest, most sophisticated investors on the planet. If you look at a league table of the world's largest pension funds or the world's largest sovereign wealth funds, in both cases, Mercer has ongoing relationships with more than 40 of the 50 largest investors. We're not their only advisor. We're not their only strategic partner, but we tend to be in the room when they're thinking about, these days it's virtually in the room, not physically in the room, but we tend to be in the room when they're thinking about their toughest challenges and trying to capture innovation. And so we get to co-create with them. We'll be in that room and they'll have 3, 4, 5 other strategic partners in that room trying to attack a challenge that the industry doesn't have an answer to yet. And innovation is going to come out of that process that none of those strategic partners, including Mercer, could have done on our own. But because we're in those rooms in a figurative sense on an ongoing basis with so many of the world's largest, most sophisticated investors, that's another comparative advantage that we have in capturing innovation. Another part of your question is, how can pension funds act on this? And the most sophisticated, the largest, do move quickly. So some pension funds are set up to have a comparative advantage in governance and can act very quickly on ideas. Others aren't, and they don't have to be. The great thing about these very sophisticated clients and these investment managers trying to drive innovation is they're keeping the markets very efficient on an ongoing basis. Market efficiency, in our view, the inability of most investors to find information that lets them beat the market in a systematic way, that doesn't happen by accident. That happens because asset owners are agile in funding innovative ideas that investment managers have. And as those asset managers buy and sell securities, they're changing the market prices to get that information into the market price. So most pension funds can be free riders, and most family offices or retail investors can be free riders. They can pick their asset allocation, put all of their governance effort into strategy, the right strategy to achieve their outcomes. And when it comes time to implement, they can invest in passively managed index funds and have a reasonable belief that they're going to beat the majority of other investors out there at much lower fees. That's a great thing, to be able to be a free rider and get a good result. Now, if you could have been one of the organizations with a competitive advantage in governance, if you were willing to spend the money on staff and consultants and partners to do that, and instead you're a free rider, you're probably giving something up. But most institutions aren't big enough or sophisticated enough, or they have other constraints around what they can pay staff and so on. If you look around the table and you don't know who the dumb money is in a poker game, then it's you. And it's much smarter to say, I don't have a comparative advantage in governance. I'm going to be a free rider, and I'm going to do that deliberately, and I'm going to get a good result. I'm going to get it cheaply. I'm going to get it reliably, as opposed to trying to play the game. But large, sophisticated funds do have, we think, a comparative advantage in governance and can move quickly.
I always thought that it's more the smaller to medium size investors that actually would employ investment consultants, because I thought they would have a large in-house team and not outsource that. How is it that you work with the largest investors of the world, and why do they not have in-house teams?
So the largest investors in the world definitely have in-house teams. I dialed in for a call that started 4:30 in the morning my time yesterday with a Middle Eastern client that employs many hundreds of in-house staff and does direct investing and highly sophisticated. And they would say they don't use consultants in the traditional way. They don't need a monthly or quarterly monitoring report. They don't need a formal manager selection report and help with finalist interviews. That sort of classic governance model that we see in the mid-market is not what they need. What they need is a window on the world of what do other investors that are hundreds of billions in assets and have hundreds of in-house staff, what are they doing around delegation of authority, investment processes and procedures, engaging with the general partner community, accessing co-investments and secondaries. Whatever the issue is, they want to know what are other super smart sophisticated players like us doing. And so having a consultant at the table that works with other large, ultra sophisticated asset owners helps them. What they also need is help with that co-creation. And so they need a partner that is able to sit at the table and participate in a diverse build with other strategic partners, including organizations that may be securities managers or investment banks or otherwise not from the consulting industry. The reason we have large share there is our digital manager research offering and our digital strategic research offering. We, 20 years ago, decided that niche of sophisticated clients, they don't need our traditional services, our performance evaluation reports, our manager selection reports. What they need is when we do qualitative forward-looking research, when we think we found something innovative, or when we think we found something that the manager thinks is innovative, but we actually think is parallel invention with 20 other people, they get that on their desktop. And it's not that they take our manager research note and that tells them exactly what to do. The feedback we get from the in-house staff is the meetings I took and the meetings I didn't take because I read your note pays for the subscription to your research X times over. It's just such a productivity enhancement. I wake up in the morning and there's 215 Mercer manager researchers feeding me stuff. And I can look at that and then prioritize my own efforts. And I'm so much more productive than if I'd done some of those meetings myself. Because classically what happens is somebody gets in to see one of these in-house staff and they've flown halfway around the world and you're 5 minutes in the meeting and the in-house staff realizes this is a complete waste of time. And in some cases, they just throw the manager out. But in most cases, they give them 45 minutes or an hour because you can't really have somebody fly halfway around the world and throw them out after 5 minutes, even if it's a waste of everybody's time. When you read our notes, that almost never happens. The in-house staff is down the curve. They know the strategy. They know it's a potential fit. And so whether the manager's coming to see them or whether they're planning a research trip and coming to see the manager, it's not going to be a waste of anybody's time. Because we've got that digital capability, that willingness to share all of our research on an ongoing basis. When that same in-house staff member has a question that's of a strategic nature and is thinking about who am I going to call? Who am I going to bring into that room with my other strategic partners to brainstorm about, what do we do about negative interest rates? What do we do about the VIX trading at 85 instead of 20? What do we do about this historically unprecedented threat or opportunity? They're going to call Mercer first because we've got the ongoing relationship with them as the provider of their digital research.
You mentioned several times investment managers that are innovative and that impress you. But what kind of criteria are you looking at to see if a manager is innovative? What kind of attributes do they need to bring to the table to jump the hurdle and to be labeled as innovative or to get a good review from you?
So there's 4 factors that we look at that we believe are necessary and sufficient to beat the market. And it's competitive edge in idea generation, portfolio construction, implementation, and business management. And by far the most important of those 4 factors is idea generation. So how does the investment manager for a particular strategy figure out what's going to drive securities prices ahead of time? How do they source ideas about what's going to move markets or the values of individual securities and have competitive edge again in that against other investment managers that may be just as smart and just as well resourced and have all the past success credentials? Do they have competitive edge? That's the most important. If you don't have that, you can't beat the market. You need competitive edge in idea generation. Portfolio construction is how do you create a portfolio of securities that is exposed to areas where you have an inside edge and not exposed to risk factors where you don't have a view. How do you avoid giving back your value added through bad luck in areas where you didn't intend to take a position? Implementation is how do you trade that portfolio on an ongoing basis cheaply but quickly so that you get the value of your ideas. You can be early and be right and not move the market as you do it and give up in transactions cost the value of your ideas. Those first 3 factors are necessary and sufficient to beat the market against your peers. Business management comes in on a longer term time horizon. Are you constantly enhancing your competitive edge on the first 3 factors, or are you giving that up because you've got personnel turnover or you've got your portfolio managers running around doing sales presentations and not managing the money, or you get complacent and because you've had good results for a year or 2, you think, okay, we've got this lift, we don't need to innovate, and other people pass you in innovation. So we're very forward-looking in trying to identify innovation. And we're very focused on, across all the managers we talk to in the same asset class, our manager research is specialized by asset class. So if I'm a researcher on emerging market equities, I'm talking all the time with the best emerging market equities managers in the world who has competitive edge at a point in time. And the psychological dynamic is a team that's been outperforming will relax a bit. They'll think, okay, we got this. Clients love us. We're doing well in the markets. What we're doing is working. Don't mess with success. First, do no harm. Another team that's equally smart, but it hasn't been working for them because they lost their competitive edge, is going to be at the grindstone thinking about how do we innovate this process? It hasn't been working as well. What can we do differently? So you're constantly passing each other. It's like an ongoing competitive race. Now contrast that to what you hinted at earlier with your question around pension funds. Most of the industry, most of our competitors looks at things like assets under management, length of track record, stability of teams, stability of process. When I entered the industry 30 years ago, if we met with a manager and they said, we've been doing the same thing for 20 years and it's been working, it's the same team, it's the same process, we believe it's replicable, that was a good answer. Today, if a manager came in and said, we've been doing the same thing for 20 years and we're going to keep doing it, with the pace of development of new information sources and the pace of innovation in asset management, you'd be surprised they were still in business. You can't do the same things you're on. You can have a discipline. You can be disciplined about how you get innovation. But to say we're going to do the same thing year in, year out and trust that it's going to keep working, I'm sorry, the market's just too efficient. There's too many other smart people trying to do the same thing. Even if your secret sauce doesn't leak, other people will get at it through parallel invention over time. So one of the paradoxes is the markets are very efficient. It's very tough to be a securities manager and beat the market. Picking active managers is not very efficient because most people who are picking active managers are looking at measures of past success. They don't have the resource to get at competitive edge to look at what we believe are the drivers of future success.
How do you discern what is actual innovation? Like what kind of questions do you ask? What kind of methods do you use to test their approach? Because if it's a new idea, there's no track record, you can't be sure whether it's going to work. So do you try to backtest the strategy, or do you try to look into the model and see if the approach makes sense, ponder them with questions and see at which point their answers get laggy? What's the method to find out if a strategy is relevant?
I would say that's, in my opinion, impossible to do on an absolute basis and easy to do on a relative basis. And what I mean by that, so I'm a generalist investment consultant, and I'll meet with a global water technology manager and think, smartest person I've talked to in 6 months, that was so interesting, it all sounded so innovative, I can see how that would work, I believe there's great returns there, I'm just so impressed with them. And I walk out and I ask my manager researcher, who's researching water technology managers all time as a full-time job, what do you think? Well, there's no innovation there. Like, what do you mean? They're brilliant. And what's happening is the researcher is meeting with people like that all the time. And they're hearing exactly the same thing from this very smart, well-researched person that they've heard from 20 other people. And we'll go to a different meeting and I'll be equally impressed because I don't know that much about water technology. I'm a journalist. And my researcher will come out of that meeting saying, okay, I heard 7 things there that are different than I've heard from anybody else. And it's clear that if they exploit those 7 things, they're going to beat the rest of the pack. So on a relative basis, it's easy to evaluate competitive edge. On an absolute basis, you can't. I'll give you a different example. My 12-year-old crushes me these days in basketball. He's just so much better than I am as an adult. But then we've got him on an AAU team where he plays in New York City, and all of a sudden I still think he's above average, but he's above average. He's not going to make it to the NBA. And so the investment managers who survive in the industry are brilliant. They're great at what they do. Within the population, they're like top 0.1% or better at what they do, but they're competing with each other and getting at the best of the best. You have to do it on a relative basis. You can't do it absolute. The other part of your question is about completely unproven things. And I think the biggest gains are to go into a new asset class or sub-asset class early when nobody has a track record and make that investment. But then you diversify so that if you get some of those calls wrong, and some you will get wrong, it won't pan out the way that you expected or the manager expected. On average, you're trying to win. You don't have to be right every time. And so one test for whether an asset owner should be a free rider as opposed to trying to push the envelope and beat the market is, can they stomach getting some things wrong? Do they have single line item risk tolerance? If they invest in 10 really innovative private equity ideas and one of them goes to zero, is that going to cause a stakeholder to question the whole process and say, why are we doing private equity? We clearly got this wrong. How could you make that mistake? As opposed to, okay, on average across the 10, we beat the market, we beat the rest of our portfolio, we should do more of that. What's the governance model? What's the stakeholder risk tolerance? What's the sophistication level? Can you make diversified bets, accepting that sometimes the odds may have been in your favor on average, but you got some individual positions where you didn't get a good decision, bad result?
You mentioned several times investment managers that are innovative and that impress you. But what kind of criteria are you looking at to see if a manager is innovative? What kind of attributes do they need to bring to the table to jump the hurdle and to be labeled as innovative or to get a good review from you?
So I think for all of our client segments, the most important thing we do is help with objectives, risk tolerance, and long-term strategy. And by far the toughest of those and most important is, what are the investment objectives and what's the associated risk tolerance? So an investor may say to us, we want an 8% nominal return, or we want a 4% above inflation real return. And then we'll go through over what time horizon and why do you want that? And are there any unique things about your organization that would cause that objective to differ over time that would also hit the investment portfolio? So an example is, if we're working for a sovereign wealth fund from a country that has oil reserves or copper reserves, if oil prices rise over time, stay healthy, the country's going to be okay anyway, and they're going to be able to fund the sovereign wealth fund. If oil prices crash for whatever reason, economic recession, technological innovation, if oil prices crash, the country's going to be in trouble and need to look to the sovereign wealth fund for better returns. So that sovereign wealth fund may have said to us, we want 8% nominal or 4% real. And if we just took that at face value and didn't ask other questions, we could have put them into a strategy where they were getting that 8% or 4% by betting on oil prices staying stable or rising. And what we would have done a disservice to is, their objective set actually is, we want 8 nominal or 4 real, but we're going to really need that when oil prices get crushed. And so put us in a portfolio that hedges against oil price risk, and we'll be a lot happier through time. We'd still like 8% nominal, 4% real, but when it's most valuable to us is when the value of what's in the ground and the value of what we're earning by taking it out of the ground is under threat. That's when it's more valuable. So you need to ask a lot of questions to get at the real investment objectives. And then risk tolerance, the cardinal sin for an investment consultant is to exceed your client's risk tolerance. And risk tolerance only comes into play when things go badly. Let's say we get a client and we convince them that part of the answer to their investment objectives is to diversify into alternative investments. Let's say we get them into private equity, real estate, infrastructure, private debt, hedge funds. And we do that in 2006, 2007, just in time for the global financial crisis. And markets dropped by 40%. And the portfolios that they just started creating in private markets are down and not looking like they're going to have good vintage year returns. If we did a great job with that client on objective setting and risk tolerance, that client should be saying to us, okay, the markets have really gone against us in the short term. Can we go heavier? Can we go faster? Now is a great buying opportunity. We want to go heavier into these alternative asset classes. If we've exceeded the client's risk tolerance and not done a good job with objective setting risk tolerance, the client's reaction can be, oh my gosh, we took all this risk on and it went against us in the first year after we did it. What a mistake. We need to pull out. And so you want your client to have the governance and have the mindset of buying into market opportunities, buying into weakness, as opposed to being a forced seller. The strategy process is not around the numbers. It's around helping the investment committee or the stakeholders or the board pre-experience both positive and negative outcomes across a range of economic scenarios, so that when something like that actually happens in future, and we'll never get it exactly right. We didn't predict coronavirus. We did have pandemics on the list of things that could happen, but we put clients through, okay, open the envelope, here's what's happened in the markets. And we did that based off the global financial crisis. We did it based off the crash of 87. There's plenty of historical scenarios you can use to help your client pre-experience what can go wrong, and then ask the question, in this circumstance, what do you want to be doing? And if the answer is, well, we would accelerate our commitment to risky asset classes, we would use our opportunistic risk bucket, we would be taking advantage of the opportunities, then you're in good shape. If the answer is, well, we couldn't stomach that would end the organization, we'd all get voted out of office or fired, then okay, we can't actually do that strategy because we're too path dependent. We can't stomach the downside to get the upside over time.
I mean, that sounds a lot like what you say about smoking. Don't smoke, it's bad for you. But so many people smoke, right? So how do you make sure that an investor, which during the simulation says, oh, I'm okay with the portfolio being 15% down, I'll go and buy, but then the real thing comes along and it's not just an Excel sheet that the investor sees. How do you make sure they really stick with their earlier decision?
So we just had a really live test, and we were worried about it. We had 10 years of relatively well-behaved markets and stocks hitting new highs on a routine basis coming out of the global financial crisis. And so when we looked at whether it was senior staff at our clients or investment committee members and boards, there were still a small minority of people who'd been in those types of roles when the GFC hit. But 10 years is a generation in the investments industry. So a lot of the people around the table hadn't been through that before. And we weren't sure, we put them through these hypothetical scenarios, and I'll come back to how we did that in a second, but we weren't sure whether they'd really have the risk tolerance. And then we had a much sharper, faster correction, losing 40% on stock markets in 2 weeks with the coronavirus crisis. And we weren't sure whether clients would have the risk tolerance to do rebalancing or deploy their opportunistic risk budgets. And we were pleasantly surprised that they did. The clients that had pre-experienced crises said, finally, we've got a meaningful market correction stuff to buy. Like they've been waiting for 10 or 11 years to put this plan into practice, and they finally got to pull the plan off the shelf and implement it. And so that did work. I think to your point about the metaphor of smoking commercials, part of how we get them there, if we're talking about a defined contribution scheme, we'll have personas, and we'll actually show a picture of a person in their 30s, and then that same person 40s, 50s, 60s, 70s, 80s. Often we're using software to age them digitally as opposed to actually having live pictures. But we're helping humanize it. Like most people, even good board members, good investment committee members, they got there by being really good business people or good in their day jobs. Maybe they're a doctor, a lawyer, whatever. They didn't get there by playing poker. They can't think in numbers or math the way that an investment professional might tend to do or have been taught to do. They think in human terms. So if we're working with a university endowment, we'll say, in this scenario, the money available from the endowment to help the budget of the university would fall to the point that you can't afford these things. You can't afford to offer these scholarships you've offered, or you would spend the endowment down within 7 years if you kept at it. We try to bring it back to human terms. If we're working with a not-for-profit hospital, here's what we do to your P&L. You wouldn't be able to afford to do as much care for indigent people, people without means. You wouldn't be able to handle the uninsured people coming in because you wouldn't have the money. Trying to bring it back to their mission and what it's really going to mean in human terms, and not just dollar terms, but human terms in different ways to make it real and help bring the psychological impact of living with that risk. So you think back to March of this year, we had markets go down for a week solid, and okay, we've been through this before, we're going to rebalance, we're going to buy in. Then they went down for another week, and all of a sudden that rebalancing decision is looking, well, why did we do that? We bought in too early, and now we've lost more money, and it's getting really threatening to our mission. And this is happening in people's real lives. They were worried about their families and their own health. And in their day jobs, if you're running a university and you're having to send your students home, if you're running a hospital and all of a sudden you can't do any elective care and you're in the front lines of coronavirus, if you're running a retail or travel company or a small business and you're looking at bankruptcy, your day job is hugely stressful. You're maximum risk there. And at the same time, the investment portfolio is tanking. And in the short term, these actions that you'd all thought about in a vacuum in this nice conference room 5 years ago, open the envelope, go through the case study, suddenly it's real. it's very hard to rebalance. It's very hard to want to buy in. It's very hard to want to provide liquidity to markets that are seizing up for lack of liquidity. But by and large, the client base did that because they've been through those exercises and been trained. At the toughest time to do that is going to be the best time to do that. And it proved out again, as it has in past crises.
I want to jump into one other topic that we quickly mentioned earlier, and that is OCIOs, so outsourced chief investment officers. How does this role differ from an investment consultant?
It differs less than I think the consensus would have us believe. And I think one of the innovations in the last 10 years in the industry, or 15 years, is towards a modern form of outsourced chief investment officer, which bundles really investment consulting advice on strategy, everything we've already talked about. The client's still going to take the decision on their long-term strategic asset allocation. And often the client's taking the decision on which asset classes they'll use. Will they do private equity or not? How much will they put in private equity? What types of private equity? Use of active versus passive management. The client's still involved in strategy. But at some point in the process, instead of the client making the decisions and then in-house staff having to implement, they're turning that over to their consulting partner and saying, you pick the managers for us. You open the accounts with our custodian, you oversee the wire transfers, you sign the fund docs with the private equity managers, you handle the capital calls. This implementation work, you're going to do it for us. And there's different variations on that and degrees. But I think what happens in an OCIO relationship is that some tasks that would otherwise be handled by in-house staff, or some decisions that would otherwise be taken by the asset owner's governance process, are delegated to the partner to do for them. And then the client can focus their resources on strategy and not worry about the implementation, except that they're monitoring the OCIO and they're going to hold the OCIO accountable for results against benchmarks. So in the classic example, clients turn over manager selection to us. And a client may say something like, we've been doing manager research with you in the consulting model for a long time, and actually we always take your recommendation. So if we use your OCIO, you'll do it for us. We'll get the benefit of your aggregate buying power. We'll pay lower fees. You guys will handle implementation work instead of our staff, and we'll have more time to focus on strategy. That's a fit for us. I think the other thing about OCIO is it doesn't have to be all or nothing. So some clients use OCIO by asset class. So they may use OCIO for alternatives, but not traditional assets. They may use OCIO for new allocations, but not existing allocations. Others do it by program. So a multinational may have a consulting and in-house staff model in their largest countries, and in small countries may use OCIO because it just doesn't make sense for them to focus their time and effort on the 80% of countries that account for 20% of their assets. They're going to focus on the 20% of countries that account for 80% of their assets.
So then the in-house CIO is more involved on a strategic level, and the outsourced CIO is more involved in the day-to-day operation and implementation of the strategy.
Yeah, in most of our OCIO relationships, we're giving the strategy advice and then we're implementing it for the client. And the benefit of that is we understand the strategy, we understand the risk tolerance. So when things happened that you didn't imagine ahead of time, go back to the global financial crisis, there was a point when swaps traded through treasuries. And before that happened, a lot of market observers would have said, well, that can't happen. And in the recent coronavirus crisis, we had oil prices go negative on the oil futures. And if you'd asked people ahead of time, can that happen? They would have said, I don't think that can happen. How could that happen? How could oil have a negative price? But when that happens, when that kind of unprecedented things happen, if the OCIO understands the client's objectives and risk tolerance, they can either do something within their discretionary authority that's going to make sense to the client after the fact, or if they don't have the authority to do it, they can go back to the client and say, can we please have permission, sign here so we can do this for you, because you're going to get a better result given your objectives. So having those two things integrated, the strategy advice and the implementation, makes the implementation better. Whereas historically, when it was more common that one firm would give investment consulting advice, and if there was an OCIO relationship, it would be with a different firm in a fund of funds model. Those off-the-shelf building blocks, they delivered aggregate buying power benefits, they delivered operational benefits, but they weren't operated with an inside knowledge of the client's objectives, risk tolerance, constraints, why their strategy was the way it was. And so in extreme circumstances like the global financial crisis, the coronavirus, market correction, you couldn't get this very fast opportunistic play on, well, here's a big opportunity, big threat, and here's exactly what we're going to do about it because we understand what the client's trying to do.
How do I imagine an outsourced CIO? Is say, endowment hiring one certain person that is responsible as the CIO? Or is this one person responsible for several clients? Or is it always a team of people responsible for multiple clients? How does it work in practice?
In our case, it's always a team effort. I think industry-wide, it's generally a team effort. So around half of our assets under management as an OCIO are custom implementations, and the other half make use of our multi-client pooling vehicles. When a client's making use of the multi-client pooling vehicle, they'll have a strategist that they work with. So a single team member backed by a team, but kind of a front person for the strategy advice. And then there's a portfolio manager for each of the strategies, each of the asset classes in the multi-client pooling vehicles. And so it's very much a team approach there. In a custom case, we may have a client portfolio manager that's atop the entire implementation, but they're still going to work with the same asset class leads that manage our multi-client pooling vehicles. We'll be giving them very strong advice or taking delegated authority to implement the individual asset class sleeves for that custom client. So it's a team effort, but we try hard to make sure that there's a single person the client can go to who understands their strategy, risk tolerance, constraints, governance, what they're trying to achieve and how, and who's accountable to them for everything that we're doing for them. And that person is the interface between the rest of our organization and the client. And everything we've talked about so far is related to front office decision-making, but there's a lot of operations work that happens in the OCIO model. We're getting daily feeds from the custodians. We're loading those securities into our software to check against risk tolerance guidelines and ESG criteria. We're making sure that the risks in the portfolio are in line on a daily basis and pass compliance checks and make sense to us given the client strategy. That information is all getting loaded, aggregated, and then we're trading across the portfolio to rebalance exposures across sub-advisors or deploy new contributions to the client, raise money for benefit payments, raise money to meet capital calls, deploy distributions. So there's a daily trading cycle and there's an operations team that's full-time, real-time, making that all happen, which generally does not exist in the standard consulting model. In the consulting model, the client's in-house staff are doing that, but they're generally doing it with monthly data from the custodian and the managers and with a lag, whereas in the OCIO model, that's typically on a daily cycle and happening in real time. So you pick up some implementation and risk control benefits in the OCIO model that aren't typically available in the consulting model.
Now, I have one more question that I was very interested about, knowing this is a huge business for Mercer. You mentioned them a couple of times throughout the conversation, pension funds. And you said in the beginning, I think you mentioned defined contribution. I know there's defined benefit. Can you shed some light onto the differences between the two sorts of pension funds and how the industry is developing?
In a defined benefit plan, the plan sponsor, which is often the employer of the participant or the employee, the individual, the plan sponsor is committing to provide a certain financial outcome to the participant. So it could be a dollar amount of lump sum. It could be a proportion of final average salary. It could be a proportion of final 3-year salary. What the outcome is can vary by plan. But the sponsor is saying, if you work this many years for us and you have this salary history and you retire at this age, it's usually age, years of service, and salary history. There can be other criteria, but if you do X, you're going to get Y. And a participant who knows with certainty, this is what my career is going to look like, and I'm going to retire at this date, and I'm going to have this salary history and years of service and so on, they'll be able to figure out exactly what they're going to get. It may be inflation adjusted, it may not, but they're going to know what they're going to get. And if what's contributed along the way is not enough to fund that, the sponsor has to make that up. So the participant doesn't have to worry about the investment earnings because they're going to get that outcome regardless of the investment returns. So the investment risk and the funding risk is with the plan sponsor. In a defined contribution scheme, what happens is the sponsor says, I'm going to contribute X to the plan. I may do other things for you. I may arrange a record keeper and investment management arrangements and do my best to make sure those are high quality, but I'm going to contribute X. And how you invest that is typically up to you. In some cases, the sponsor decides how to invest it. But whatever happens with the earnings over time at retirement, you get what you contributed, what was contributed for you, plus anything you contributed, plus the earnings. So neither one of us has any idea what that outcome is going to be. We can project it, but it's uncertain. And in the year before your retirement, if the markets drop by 40%, I'm sorry, your account balance just dropped by 40%. It's your risk. It's not on the sponsor, it's your risk. So there's defined benefit schemes where the outcome's guaranteed and the investment risk is with the sponsor. There's defined contribution schemes where the input, the contribution from the sponsor is committed, but the outcome is variable and the investment risk is with the participant. And then there's hybrid schemes where the sponsor may create a corridor and say your outcome is going to be within this corridor, and where in the corridor is going to depend on, so it's defined contribution within the corridor, but above and below a certain level, it goes defined benefit, or there may just be a floor and no ceiling, floor offset plan. So there are hybrid arrangements, but basically most of them are DB or DC.
How does your involvement then vary? I mean, in a defined benefit contribution plan, I can understand because you have to hit that target number, similar to an endowment. But how does it vary when it comes to a defined contribution plan?
So defined contribution is tougher because we think of it as B to E to E. So we're a business advising an employer about something they're doing for their employees. And both Mercer and our client, the employer, has to think about the psychology of individual decision-making. With a defined benefit plan, we talked earlier about investment objectives and strategy and risk tolerance and governance. We're taking committees through that scenario around, do you have the risk tolerance to stomach this? With a defined contribution plan, the committee is taking decisions about what to offer to participants, but typically those participants are then choosing what to invest in. And we don't have as much opportunity to educate them. We're not meeting with them face to face. Typically, they don't have a lot of bandwidth to get educated on investments. So we're trying to design what we call smart defaults, and target date funds are the classic example, where we try to make it really easy for the participant to get into a high quality, diversified investment strategy that's going to match up well against their risk tolerance and needs and deliver an outcome that they'll be happy with or reasonably happy with without exceeding their risk tolerance in downturn. And what we and the industry in general have come up with so far that seems to work well is the target date fund design, where you say to a participant, if you think the date you're going to retire at is X, then this is probably about the right option for you. If you want to do something custom, you can, but this is a smart default. This is something that if you don't make an active choice, you're going into this as a default, and it's the best we can make it without knowing anything about your specific circumstances outside of work, your other savings, your savings history, your net worth, what you might have inherited, what your partner or spouse is doing. So it's not perfect, but it's the best we can do without getting a lot more information. And if you want to provide that information to a managed account or a financial planner, then you can do that and do something custom, but here's our smart default. So defined contribution is tougher because we're dealing with individual investor psychology. We're dealing with masses of employees. Their capacity to engage is limited. They're not focused on retirement until they get close to it typically. So the best we've come up with as an industry so far is target date funds.
Now I know that defined contribution is actually growing faster than defined benefit, and I think it's more of a switch. Can you shed some light on why this is happening and what's the industry trend here?
Yeah, so two levels. In the developed Anglo-Saxon economies, so Australia, New Zealand, US, UK, Canada, Ireland, where pre-funded corporate defined benefit was the main form of savings. We could throw Japan in there also, which breaks the Anglo-Saxon model, but they borrowed it from the US. Pre-funded defined benefit was the norm, and corporations, employers were the sponsor. What's happening there is employers have been through a series of crises: the tech bubble, the US housing crisis and global financial crisis, most recently coronavirus. And it's not their core business to offer retirement benefit arrangements. When it goes well, they earn more than the actuaries and investment consultant told them to expect. The benefits go to employees typically. When it goes badly and there's a market correction, the employer has to pay more. So they're looking at that saying, this is not a two-sided bet. When it goes well, we don't get the benefit. When it goes poorly, we have to pay more. Why are we doing this? It's not our core business. And so corporate employers are shifting from offering defined benefit plans to offering defined contribution plans. And if you look at new economy firms, dot-coms, newly established enterprises in those countries that historically had DB, they're almost 100% DC. They're not offering DB at all. When you look at old economy firms, they had DB, auto manufacturers, auto parts manufacturers, banks that have been around a long time, they had DB, but they've closed the plan to new entrants. In many cases, they've frozen the plan to further accruals. And so on a go-forward basis, they're only offering DC. So that's what's happening in those economies. In the rest of the world, places like China, India, Singapore, Malaysia, pre-funded corporate DB was never dominant. And as those governments have looked at, okay, we now have an opportunity to worry about, we're wealthy enough that we can worry about retirement income security. People aren't starving anymore. We're at a level where we can worry about long-term needs in the Asian population. What are we going to do about that? Well, they look at the US as one example where Social Security is close to bankrupt, projected to run out of money. And they could look at other countries and see the same thing. And they say, well, that's not sustainable. We're not going to do that. And those countries that were wealthier before us, they're moving to DC. So we're just going to skip to the end. It's sort of like never having landlines for phones and going straight to mobile networks, never having bank branch banking and going straight to ATMs. You skip straight to defined contribution. And you don't do it employer-based. You just have a national defined contribution scheme like the Central Provident Fund in Singapore or the Employees Provident Fund in Malaysia, or the mandatory provident fund in Hong Kong, which doesn't look like a national scheme because employers are picking the default provider, but there's multiple default providers competing for business, and each employer doesn't have their own scheme anymore by and large. There's maybe a dozen left that are employer-based. The rest are using these multiple employer plans. Australia, New Zealand, the Nordic countries, there's a lot of countries, including some developed markets, that have gone straight to our Social Security scheme is going to be national DC. The Latin American countries that have an AFP or 4A system, we don't think of those as national DC because there's multiple competing private sector providers. But the employer's role is to pick a provider and remit the contribution. And in most cases, if the employee wants to pick a different provider, they can do that. The employer is only picking the default. So it's employee choice of provider, it's employee choice of investment. The employer contributes and that's it. And the government takes care of regulating those providers. That seems to be a stable equilibrium. So the path from DB to DC seems to be one directional. Companies move from DB to DC, they don't move back. Governments move their Social Security from DB to DC, they don't move back, is what we're seeing globally.
I can see the appeal that this scheme has for companies and governments. Then only the question comes to mind, the people that are invest and take the risk now, can they live off the money that they made over time? And this is, I think, a very big discussion to maybe have at another point.
Well, I think that's a huge question. And it's interesting because I mentioned earlier, it's hard to get defined contribution participants to engage with the scheme. But with the decline in interest rates globally, for example, in Chile, which historically was seen as a model for Social Security and DC system, because of the reduction in interest rates, the annuities that individuals can buy when they hit retirement are now paying much lower. It's a lower annuity rate. So with a given lump sum, you're buying less retirement income. And we've literally had riots in the street because that interest rate risk wasn't hedged in the scheme design. And so participants are now surprised that they did everything. They feel like they did everything the government told them to do, everything they were encouraged to do, defaulted to do, and they get to retirement and they don't have enough to live on. So it's a very real issue. But in the defined benefit countries, that's going to fall on the government and taxpayers to make up. In the defined contribution companies, the individuals will have to adjust their working lives and their savings to offset the impact of lower investment returns or lower interest rates. It is a key issue, and we have a huge gap against retirement income security needs globally. I think the other reason that DC is prevalent at a government level is labor mobility. So it's not just that the governments don't want to take the investment risk on their own balance sheet and have that fall through to taxpayers. When they look at how do we have an economy that's as efficient as possible and get our labor to move from old sectors to new sectors, so we have faster per capita GDP growth, we have higher productivity, we have better tax receipts, we have better wealth creation. It's important to have a flexible labor force and have labor move from employer to employer easily. A defined contribution scheme makes that easy because your savings goes with you. A defined benefit scheme gets in the way of that because most employers build in incentives to their defined benefit design, vesting, and so on, to cause employees to stay with them longer. That may make sense for that company. At a societal level, it makes the labor force less mobile. So when Japan introduced Japan 401k, Japanese defined contribution, we consulted to the Ministry of Trade and Industry and the Japanese Chamber of Commerce on that. And a key reason they did it was to make the Japanese labor market more flexible. They felt like having people stay with an employer because of the defined benefit scheme, when actually if they moved to a different employer, they could make more salary. It just wasn't bad for the economy. It was hurting GDP growth. So they introduced DC explicitly to try to create more labor mobility.
That actually makes a lot of sense. I've never seen it that way, but then I guess what really is needed is for people to get better and more financial education to really take full advantage of the opportunities provided. And this is going to be huge in the future. Now, I don't want to take up too much of your time, but I would love to get some career advice from somebody as experienced as you. So do you have any tips for our audience?
The consulting industry, if you like working with people, if you like a balance of quantitative and qualitative, if you like being exposed to the most innovative minds in the world and have investment managers literally trying to break down your door to tell you about their latest innovation, not quite literally, but pretty close to it, it's a great industry. If you want to manage money in the sense of picking individual stocks or bonds, I wouldn't come to the consulting industry. I'd go straight into investment management. But if you want to do marketing, sales, business management, other things in the investment management industry, or be in-house as the chief investment officer of a large asset owner or an investment officer in a large asset owner, consulting is a great place to get trained and go in-house. It's a great place to get trained and go into business management for the asset management industry. So I've enjoyed it. I'm 30 years in and still learning things every day. And I wish I'd known about it. My guidance counselors never told me about it. I got into it by accident and feel very lucky and fortunate that I got into this part of the industry because it's not well known, but it's a great thing to do with your career.
Thank you, Rich. This is some really good advice, and I hope it inspires some listeners to check out the investment consultancy industry. And this is what we always try to do, right? To provide the people a look into certain parts of the industry they might not have heard from their guidance counselor or from the popular press before. So thank you so much for giving us an insight into your daily work, into this industry that is huge, but it's not much on the radar. Thank you so much for coming on the show, Rich.
Thanks, Andreas. Thanks for having me.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.